stocks really around the world, and particularly here in the U.S., are sliding today on renewed fears of a global slowdown. The major indices losing more than 2% here at home. Joining us now with more on what is behind this global sell-off and how you can protect yourself is Charles Bobrinskoy. He's vice chairman of Ariel Investments, where he helps manage over $5 billion in assets. Charles, you and I seem to talk on really painful days in the market. Last time you were on in May, you said on a scale of 1 to 10, investor fear was at an 8. Where are we now?
Probably have to take it up a notch, 8.5. It's not as bad as it was in March of '09, but it's pretty bad. And clearly, people are worried that we're going to go through what we went through in late '08, early '09. I don't think we are, but that's clearly where the fear index is.
Now, the retail investor has been hesitant. Obviously, May didn't help convince them to get involved once again. I mean, what do you do? I know you personally were staying fully invested here, but have you changed your strategy as a result of some of this volatility?
No, obviously the worst thing you can do is to sell when other people are selling. Obviously the best time, this is the hard part about this business, but the best time to buy is when other people are selling. So we do have this strange anomaly in the market that some of the very highest quality companies with the most predictable and sustainable earnings are actually trading the cheapest. And so that's where we've been investing.
Yeah, you said, when you were rebalancing, the places you're moving money around to were online education stocks. You liked healthcare stocks. What do you like right now?
Healthcare in particular. I mean, on days like today, actually, names like Johnson & Johnson are outperforming pretty nicely. Merck, some of the other pharmaceutical companies, which tend to be less economically sensitive, are doing well on days like today. And what's nice is those names are very cheap. Johnson & Johnson is about 11 times earnings. That's particularly notable in a world where you've got 1% two-year treasuries. So you've got a very dependable cash flows coming from Johnson & Johnson, and we think those quality stocks are going to get bid up here.
You mentioned the bond market. The 2s and the 10s seem to be indicating a real level of fear out there. I mean, how does that change your position here? I mean, do you consider yourself very defensive right now?
No, I actually don't. I think when we will take a little more risk as fear increases. That's the best time to be buying riskier assets. So there are some names, higher quality names, like let's say a Disney, which is economically sensitive but still very high quality, that we'll add to in a period of fear like this. But then we'll buy the very high quality, less cyclical names if they're just very cheap, like the healthcare names are here.
Are you looking at other alternatives on the cash front? I mean, besides the Treasury market right now, how else are you keeping sort of money aside?
Yeah, we don't like to try to time the market. I mean, we think building up a cash reserve because you're worried about the short-term market fluctuations is not a good long-term strategy. The only time we'll do that is when we think the overall market is just too expensive, and we don't think that right now. If anything, the market in total is actually offering us pretty good opportunities, so we're keeping cash levels pretty low.
About 2%?
A little less, actually. That's coming from the dividends that we're earning. We have so many companies that are paying a high dividend yield, again, like a Johnson & Johnson, so that is keeping cash coming into the portfolio. But we're keeping, as you say, less than 2% cash.
When you look at personal income numbers, they indicate consumers are perhaps holding on to their money a little bit more. You hear concerns about financial reform, meaning that lending might tighten up a little bit. Are you concerned about financial flows right now? I mean, with this hesitation on the part of the retail investor?
Yeah, I would say that banks have already tightened up. I would think that bank balance sheets are actually in pretty good shape. If you talk to bankers, you would say one of their problems is actually lower corporate demand for loans. So the short answer is no. We think lending is, if anything, going to get better.
All right. Charles Bobrinskoy of Ariel.